The volatility index, or the VIX, is a contrarian sentiment indicator that helps to determine when there's too much optimism or fear in the market. When sentiment reaches one extreme or the other, the market can often reverse course. So I typically look at the VIX chart to help me understand where the market may lead. And I think of the VIX as looking into the soul of the market because options are the playground of the big market players. So let's take a look. Before I begin, I just wanted to show this to you. This is the white paper from the CBOE, and it goes into depth with regard to the VIX, what it is, and particularly the calculations. We're definitely not going to get into the calculations. You take a look at the white paper and you'll understand why. But you can see the URL up there in the address bar, and you can research that paper on your own. The VIX is based on data collected by the Chicago Board Options Exchange, or the CBOE. So each day, the CBOE calculates a figure for a synthetic option based on prices paid for puts and calls. And those prices are based on the S&P 500 option series. So the key question the volatility index answers is, what is the implied or expected volatility of the synthetic option on which the index is based? So we already know the following variables, such as the market price of the S&P 500, the prevailing interest rate, the number of days to expiration of the option series, and then the strike prices of those option contracts. What the equation solves is the implied or expected volatility. So what is volatility? Well, it's the rate and magnitude of changes in price. In simple terms, volatility is how fast prices move. When the market is calm and moving in a trading range, or even has a mild upside bias, volatility is typically low. On these kinds of days, call option buying, which a call is a bet that the market will move higher, generally outnumbers put option buying, and a put is a bet that the market will go down. So this kind of market typically reflects complacency or lack of fear. Now, conversely, when the market sells off strongly, anxiety among investors tends to rise. Traders rush to buy puts, which in turn pushes the price of these options higher. This increased amount investors are willing to pay for put options shows up in higher readings on the VIX. High readings typically represent a fearful marketplace. An oversold market that is filled with fear is apt to turn and head higher. So the volatility index works well in conjunction with other overall market indicators. So by studying its message, traders will have a better understanding of investor sentiment and thus possible reversals in the market. And looking at this chart here has demonstrated that the VIX and the S&P appear to have a direct relationship with significant spikes and curves occurring just about the same time or within a 30-day period. So now let's go to the current VIX chart. We're looking at the current 20-year monthly chart on the CBOE Volatility Index, and the symbol is simply VIX. Other variants include the VXO, but we'll just simply use this here today. Again, this is the monthly chart, and if you go back to, say, 1999, you can see that the peak there is coinciding with beginnings of the dot-com crash. There were other peaks here in 2001, 2002. Of course, the big peak was here in late 2008. And as we discussed before, it doesn't coincide exactly with peaks and valleys in the market. So even though the VIX peaked here in early 2008, the bottom of the market didn't occur until, say, early 2009. But it's a good enough indication for me. So hopefully it will be for you too. We had other peaks here in 2010, also in 2011, most recently then in mid to late 2015, and of course earlier this year in the January-February time frame. So subsequent to that peak earlier this year, the VIX has been calming down, moving down, and its close on Friday was 11.99. If you remember back in late 2017, there was a lot of market complacency, and that coincided with a very low VIX under 10 here. So remember, the VIX is a contrarian indicator. When it peaks or spikes, those are downdrafts in the market. And then when the VIX calms down, moves down, that's when the stock market continues in an upward bias. So where are we going to go from here today? So let's go take a look at the MAC. And we've had this peak at this point here, and it looks like the fast line is about to go through the slow line and continue heading down. So I'm thinking that the market is relatively calm and is going to continue calming down here, meaning that the market is going to continue in an upward fashion. And we can see that the market continued upward during this time frame as well as this time frame, and of course in this time frame and other time frames as well. So I'm expecting the market to continue on upward based on the VIX coming down. Moving into the histogram, we see the same sort of indication there. Things are moving on down. Into the relative strength, it's already below 50 and perhaps going to continue a little bit further down. The stochastics clearly shows fast line moving through the slow line, heading on down below the 20 line. And then lastly here to the Williams. Williams continues to calm down as well, down into this negative, below the negative 80 territory. Back up here to the main chart. So basically, I'm taking a look at the VIX as just one of the tools that I use to help me understand the direction of the market. So what it's telling me right now is that the market is going to have an upward bias simply because the CBOE VIX is calming down. I think that the VIX is going to head down toward that 10 level, which was consistent with these measures back here. So for now, I think the market continues in an upward bias. So for today, that's ChewDog Charts. Thank you.